Hi, I'm Ed Fulbright, CPA, CGMA, PFS of Fulbright Financial Consulting, PA. We would like to welcome you to our educational briefing.
With the stock market breaking records for months, fear of a bubble is growing, but so is evidence that the new tax law is boosting the economy more than initially thought. In 2015 and 2016, stocks essentially went sideways. After the November 2016 election, stocks broke out. Since the election 14 months ago, the S&P 500 is up 33%, largely on the promise of lower taxes. In just the last few weeks, since the December 22nd signing of the tax law, Wall Street analysts sharply hiked their earnings estimates for the S&P 500. Earnings expectations are surging, and earnings are ultimately what drives stock prices. It explains why stock prices soared recently. Since 2001, earnings on large company stocks averaged a growth rate of 7.4%. But earnings are not expected to grow a mere 7.4% annually in 2017, 2018, and 2019. They're expected to grow by 12%, 15%, and 10% respectively. After the new tax law was signed, the average company in the S&P 500 was expected to see profits of $131 a share in 2018. But in the last month, it has been adjusted to about $155, and that is likely to be revised higher still in the weeks ahead. By historical standards, earnings surges are unusual but not without precedent. But you have to wonder how much longer the good times can last. The consensus of 68 economists surveyed in early January by the Wall Street Journal was for strong growth, averaging 2.7% quarterly through 2018. Meanwhile, the Conference Board's leading economic indicators, a forward-looking index, was just released, and it's signaling strong growth ahead. The business group's economists cited the new tax law as tailwind to the expansion. The International Monetary Fund also cited the new tax law this past week in upping its latest quarterly projection for world growth in 2018 and 2019. But the key to the sustainability of the virtuous economic cycle is the American consumer, and the newly released data on gross domestic product showed consumer strength remained intact. GDP is comprised of 4 factors, and consumer spending is by far the most important, accounting for 69% of U.S. economic activity. Net exports were a drag on the GDP growth in the fourth quarter, but net exports are volatile month to month, and its dips are usually temporary. As long as consumers keep spending, the good times could keep rolling on. Keep in mind, in February, a lower rate of withholding federal taxes on paychecks kicks in, and that will put more money in consumers' pockets to spend. While the future looks very bright, plenty could go wrong. A constitutional crisis looms larger. The nuclear standoff with North Korea is on a hair trigger, and investors could suddenly turn their focus to the $19 trillion U.S. debt and the nation's unsustainable fiscal path. A 10 or 15% drop could occur in a flash at any time, and chances of a bear market decline of 20% or more increase as the 8.5-year bull market grows older. In addition, the new tax law increases the chance that the Federal Reserve will make an interest rate policy mistake by quashing growth or allowing the economy to overheat and inflation to surge. Fed mistakes caused every recession in modern U.S. history. Despite all these risks, earnings ultimately drive stock prices, and earnings are surging. Consumers are spending, and with no sign of a recession and all major economic indicators signaling growth, the bull market and expansion could continue for months and soar much higher. Stocks are an important part of a diversified portfolio. They're the main growth engine in portfolios. But remember, stocks won't always appreciate and are only one part of a diversified portfolio. With stocks appreciating so much in the past year especially, be sure you are rebalancing properly and count on us for prudent portfolio management based on economic fundamentals and quantitative analysis.
Thank you for listening. Please contact us with any questions, and also contact us if you're interested in our complimentary second opinion on your investments or to set up a meeting regarding your wealth. Don't hesitate to share this video with people who might benefit from our work. Thank you again, and have a great day.